Hello there, this is Victor here. Welcome to the Intelligent Investor channel. In this video, I'm going to talk about Warren Buffett's biggest investing secrets he revealed in his latest shareholder letter. In my opinion, I believe Warren Buffett is the best investor in the world. As far as I know, no one is even close to Warren Buffett's investment track record compared to the S&P 500. Over the years, many well-known investors and fund managers have tried to beat Warren Buffett's investment track record, but all of them have failed. Most of them have even underperformed the S&P 500 over the long run. Warren Buffett said this many times before, only when the tide goes out do you discover who's been swimming naked. Warren Buffett took control of Berkshire Hathaway in 1965 and has turned into the most successful investment holding company in the world. Berkshire Hathaway stock had a compounded annual gain of 19.8% from 1965 to 2022. This is twice of S&P 500's compounded annual gain of 9.9% during the same period. But this is only half the story. During the same period, in terms of overall gain, Berkshire Hathaway stock had increased as much as 3.79 million%, while the S&P 500 had increased around 24.7,000%, which is still a very large amount. This means if you invested $1,000 in Berkshire Hathaway stock in 1965, when Buffett took over the company, your $1,000 investment will become as much as $37.9 million by year end 2022. This is huge because no one has outperformed the S&P 500 by such a large margin for over 50 years, except Warren Buffett. I think it will be extremely hard for anyone to beat Warren Buffett's investment track record going forward. But we can learn a lot from Warren Buffett if he studied his annual shareholder letters and studied the stocks he invests in every year. So in this video, I'm going to share with you Warren Buffett's biggest investing secrets he revealed in his latest shareholder letter. I will give you specific examples of his investing secrets and investing principles. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog. I've posted the link in the video description. Once you become a Patreon member, you can follow all the stocks I'm buying every month, follow all the stocks I'm investing in for the long term, and download the latest intrinsic value calculator so you can estimate whether a stock is undervalued, fairly valued, or overvalued now. Also, you have access to my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Warren Buffett's first investing secret is this: you have to see stocks as pieces of businesses or part ownerships of businesses, and not see stocks as pieces of paper or ticker symbols for trading purposes only. In my opinion, most investors don't see stocks as businesses. I think most investors see stocks as ticker symbols for market timing. For example, many investors like to buy stocks when they think the market is going up and sell stocks when they think the market will drop further. This is called market timing, which is very different from how Warren Buffett invests. When you're investing in stocks, let's say you're investing in Apple, you're buying a very small ownership of the business. You will need to think like a business owner and not as a stock trader if you want to be very successful in long-term investing. Also, when Warren Buffett invests in stocks, he invests in stocks the same way he acquires 100% of businesses for Berkshire. Buffett wrote this in his latest shareholder letter. Charlie and I allocate your savings at Berkshire between two related forms of ownership. First, we invest in businesses that we control, usually buying 100% of each. Berkshire directs capital allocation at these subsidiaries and selects the CEOs who make day-by-day operating decisions. When large enterprises are being managed, both trust and rules are essential. Berkshire emphasizes the former to an unusual, some would say extreme degree. Disappointments are inevitable. We're understanding about business mistakes. Our tolerance for personal misconduct is zero. In our second category of ownership, we buy publicly traded stocks through which we passively own pieces of businesses. Holding these investments, we have no say in management. Obviously, most investors do not have as much money as Warren Buffett, so we cannot copy Warren Buffett to buy 100% of businesses. But what we can do is invest in stocks the same way we're investing in private businesses. Imagine you're investing in private businesses. Ask yourself these questions. What type of businesses do you want to own for many years? And what price you're willing to pay to buy 100% of the businesses? Buffett's second investing secret is this. Our goal in both forms of ownership is to make meaningful investments in businesses with both long-lasting, favorable economic characteristics and trustworthy managers. This is one of Warren Buffett's most important investment principles. First, Buffett wants to have meaningful investments in large elephant-sized businesses that can make a difference in Berkshire Hathaway. This is because Berkshire is much larger than before. Small investments will not make a big difference in Berkshire's financials. Also, if you look at Berkshire's 300 billion plus stock portfolio here, you can see Apple makes up around 42% of the entire 300 billion plus stock portfolio, and Buffett's top 5 stocks make up around 76% of the entire portfolio. This is still a very concentrated portfolio, even though there are more than 50 stocks in Buffett's stock portfolio. Second, Buffett likes to invest in businesses with both long-lasting, favorable economic characteristics and trustworthy managers. This means he likes to invest in businesses that have large durable economic moats, favorable long-term business prospects, and first-class management. For example, Buffett started investing in Apple in 2016. Back then, Apple's market cap was only between 500 and 600 billion. Now, Apple's market cap is over 2.4 trillion. This makes Apple Buffett's best investment in the last 30 years. Buffett believed that Apple was substantially undervalued. Also, he realized that Apple has a very strong brand, a very sticky product called the iPhone, and a very sticky ecosystem that is used by everyone. For example, he noticed that everyone around him was using iPhone, iPad, and all other Apple products. He also noticed that many people continue to upgrade their iPhones almost every year or once every few years. Buffett likes wonderful businesses that are run by trustworthy management or a first-class CEO. I'll use Apple as an example here again. In my opinion, I believe Tim Cook is one of the best managers. When he became the CEO of Apple in August 2011, Apple's market cap was only around 350 billion. Many years later, under Tim Cook's management, Apple has become the most valuable company in the world with a market cap that's over 2.4 trillion. During this period, you can see Apple's total revenue, operating income, earnings per share, and free cash flow per share have grown consistently over time. Also, Apple has been paying higher dividends and buying back more shares almost every quarter. According to CNBC, Buffett only invested 36 billion in Apple and bought a 5% stake in the company in 2018. Now, his investment in Apple is worth as much as 140 billion, even after he sold a small portion of Apple shares before. I think this makes Apple Warren Buffett's best investment over the last 30 years, even better than his investments in Coke and American Express. Warren Buffett's third investing secret is this. He said, please note particularly that we own publicly traded stocks based on our expectations about their long-term business performance, not because we view them as vehicles for adroit purchases and sales. That point is crucial. Charlie and I are not stock pickers, we're business pickers. I talked about this earlier. Warren Buffett sees stocks as actual ownerships of businesses or pieces of businesses. He does not consider himself a stock picker. He considers himself a business picker or a business investor. For example, he does not judge a stock based on its stock performance. Instead, he evaluates a stock based on its long-term business performance, similar to how he buys businesses. This is very hard to do for most investors. Buffett and his long-term business partner Charlie Munger like to find the best businesses that are within their circle of competence or within their area of expertise. Over the years, I've made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. Along the way, other businesses in which I have invested have died. Their products are unwanted by the public. Capitalism has two sides. The system creates an ever-growing pile of losers, while concurrently delivering a gush of improved goods and services. Here's an interesting part you may not know. Buffett made many investing mistakes in the past. For example, Buffett said that his biggest investment mistake was buying out Berkshire Hathaway in 1965. According to CNBC, he said Berkshire was the dumbest stock he ever bought. Berkshire was not an investment holding company back then. Berkshire was a dying textile manufacturing company in 1965, and it was losing money almost every year. Buffett said that buying Berkshire was a huge mistake. He said that the mistake cost him $200 billion in today's dollars. Buffett's next investing secret is this: buy wonderful businesses at wonderful prices. One advantage of our publicly traded segment is that episodically it becomes easy to buy pieces of wonderful businesses at wonderful prices. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. Efficient markets exist only in textbooks. In truth, marketable stocks and bonds are baffling. Their behavior usually understandable only in retrospect. Buffett said, buy pieces of wonderful businesses at wonderful prices. This means we should buy shares of businesses that have long-lasting favorable economic characteristics. This is also known as durable economic moats. Also, the business needs to have trustworthy management or first-class CEO. Another important point is this that's not taught in most schools. The market is not always efficient. Often, stocks can be mispriced depending on market sentiments. Stocks can be overvalued, fairly valued, or undervalued at any given time. This means we should take advantage of the market by buying wonderful businesses at wonderful prices. Here's a personal example. I want to show you how to invest in wonderful businesses at wonderful prices. I always use this intrinsic value calculator here to calculate a stock's intrinsic business value before I decide to invest in the company. If you want this intrinsic value calculator, you can download it from my Patreon blog in the video description. Based on my intrinsic value calculation here, I estimate the Apple's intrinsic business value to be around $131 per share. This is one of my personal gold stock portfolios. I always like to invest in the best businesses at wonderful prices. I've invested in Apple for many years already. Around 2 months ago, I added 8 more Apple shares at $126 per share because I realized that Apple was likely undervalued based on my intrinsic value calculation. Now, these additional Apple shares are up around 22% at the time of making this video. Here's Warren Buffett's biggest investing secret. Have a very long investment time frame once we buy pieces of wonderful businesses at wonderful prices, so we can benefit from stocks that can grow substantially in value over time. This investing secret is called compound interest over time. Buffett explained the power of compound interest here. In August 1994, Berkshire completed its 7-year purchase of the 400 million shares of Coca-Cola we now own. The total cost was $1.3 billion, then a very meaningful sum at Berkshire. The cash dividend we received from Coke in 1994 was $75 million. By 2022, the dividend had increased to $704 million. Growth occurred every year, just as certain as birthdays. All Charlie and I were required to do was cash Coke's quarterly dividend checks. We expect that those checks are highly likely to grow. American Express is much the same story. Berkshire's purchase of Amex were essentially completed in 1995 and coincidentally also cost $1.3 billion. Annual dividends received from this investment have grown from $41 million to $302 million. Those checks too seem highly likely to increase. These dividend gains, though pleasing, are far from spectacular, but they bring with them important gains in stock prices. At year-end, our Coke investment was valued at $25 billion, while Amex was recorded at $22 billion. Each holding now accounts for roughly 5% of Berkshire's net worth, akin to its weighting long ago. Coke and American Express have been two of Buffett's best investments over the last 30 years. Buffett invested $1.3 billion in Coke, and now it's worth over $24 billion at the time of making this video. According to Buffett, Coke's annual dividend to Berkshire had grown from $75 million in 1994 to $704 million in 2022. Buffett did not do anything other than holding Coke shares for many years. Now, Berkshire owns 9% of Coke. Buffett also invested $1.3 billion in Amex, and now it's worth over $27 billion at the time of making this video. According to Buffett, Amex annual dividend to Berkshire had grown from $41 million to $302 million. Again, Buffett did not do anything other than holding Amex shares for many years. Now, Berkshire owns 20% of American Express. The key takeaway is this. Albert Einstein said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. In my opinion, if we invest in the right businesses at wonderful prices, their market values will grow substantially over time. Some of these wonderful businesses that earn a lot of free cash flow each year will continue to pay us higher dividends and buy back more shares over time. Also, I think it's important to have a very long investment time frame once we invest in many wonderful businesses at wonderful prices, so we can let the power of compound interest grow our stock portfolio substantially over time. Buffett's next investing secret is this. He wrote, assume for a moment I had made a similarly sized investment mistake in the 1990s, one that flatlined and simply retained its $1.3 billion value in 2022. An example would be a high-grade 30-year bond. That disappointing investment would now represent an insignificant 0.3% of Berkshire's net worth and would be delivering to us an unchanged $80 million or so of annual income. The lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well. If you have a portfolio consisting of, let's say, 20 stocks, and if you have invested in some of the best businesses at reasonable prices or better at undervalued prices, your larger winners will more than offset all the losers in the long run. Typically, in a stock portfolio, you only need around 60% of the stocks to be winners, and the larger winners will more than offset the losers in the long run. For example, if you look at one of my personal stock portfolios here, I do have some unrealized losses, but my bigger winners will always more than offset the temporary losers, as long as I always focus on investing in the best businesses at wonderful prices, and as long as I have a very long investment time frame. Warren Buffett's next investing secret is to ignore market forecasts and ignore what the Wall Street pundits predict every day. He believes that it's much more productive to focus on investing in great businesses instead of trying to predict the market. During the decade ending in 2021, the United States Treasury received about $32.3 trillion in taxes, while it spent $43.9 trillion. Though economists, politicians, and many of the public have opinions about the consequences of that huge imbalance, Charlie and I plead ignorance and firmly believe that near-term economic and market forecasts are worse than useless. Our job is to manage Berkshire's operations and finances in a manner that will achieve an acceptable result over time, and that will preserve the company's unmatched staying power when financial panics or severe worldwide recessions occur. Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Finally, Buffett's last investing secret is this: bet on America's economic tailwind. Buffett explained this here. America's dynamism has made a huge contribution to whatever success Berkshire has achieved, a contribution Berkshire will always need. We count on the American tailwind, and though it has been become from time to time, its propelling force has always returned. I've been investing for 80 years, more than 1/3 of our country's lifetime. Despite our citizens' penchant, almost enthusiasm for self-criticism and self-doubt, I've yet to see a time where it makes sense to make a long-term bet against America, and I doubt very much that any reader of this letter will have a different experience in the future. Instead of betting against the market or betting against America, Buffett believes that it is much better to bet on America's long-term economic tailwind. If you look at Buffett's $300 billion plus stock portfolio, you can see most of the companies he invested in are American companies. And if you look at Berkshire Hathaway's subsidiaries, you can see most of them are American companies. I also share the same view as Warren Buffett. Compared to other developed countries around the world, the US has the strongest economy and the most important currency in the world. I would rather bet on America's economic tailwind than bet against it. I hope you like this investing video and find it very educational. If you like this video and want to support our channel, remember to check out our Patreon blog in the video description and become a premium member. Before ending this video, I'll share with you one of Buffett's wisest quotes. He said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.